Hello and a lovely morning to all of you. Glad to have you all here on a Saturday morning. Let me harp on it, a Saturday morning, as the weekend is fundamentally for chilling and busting the stress that is built along the work week. I'm sure this session will be a very insightful and a eye opener to you all. So this session will be headed by Mr. Balaji GR, Head of Research and Co-Fund Manager. Mr. Balaji, kindly take over the podium.
Hey, thanks, Tarun. Is the screen is on? And
Yes, sir. It's
yeah,
visible.
thanks. A very good morning. The idea behind doing this topic on numerator and denominator is, I think we are in a very exciting phase from the market, right? I think last 6 months been a pretty good roller coaster, but I think last 3 months turned out to be extremely one-sided market where markets have just rallied from starting April, May, June, right? A record inflow from FIs who have been a seller in the last 18 months, right? Pre 3 months. So I thought it's very important to talk on where are we in the market. That's the numerator, but more to do with the denominator, which is basically what type of a risk is there with us, and a few risks which I thought I will talk about it in the subsequent slides. Then finally, right, having spoken about the context of the market and the risk, where the opportunity lies, and then we will take the questions in general. That's a broad take. To start with, just give me a minute. Um, I would say market has exactly gone this way, right? So we moved from extreme optimistic in 2021, then we moved to pessimistic, and then actually we have come back to very optimistic zone. So the market is very looks very euphoric, right? Every single day in the last couple of weeks continue to be on an upward journey, right? So there is an assumption that every day you open the screen and the screen has to go up, right? And I think this picture clearly boils down the same thing, right? So we moved from 15, 16 to 18, we came back to again 16, then again we moved above 18, 19. If you see the last few days or few weeks, right, the market's been trending steadily up. I mean, so the implicit assumption is okay, right? Making money is again looks easy, but might not be the case, right? That's a precise point I will touch upon. But I think we have come a whole hog. This picture clearly reflects again, right? I- It is a buy market when there is a pessimism, right? Precisely during March, there was a lot of conversation on what can happen to Karnataka election, what can happen to monsoon, Fed tightening cycle, so on and so forth. But for all of our surprise, market just took off from there, right? So second guessing the market is very difficult. I think with all the humble submission, we would always believe market is greater than a lot of us. I think if we have durable capital of 4 5 year, right, being invested into the market makes a lot of sense rather than thinking about saying, okay, right, I can see the market, I know the future. I think a lot of people have missed this rally. So that's a point here. But even though markets have recovered, the question keep coming is, oh, did we hit the high where there is no investment opportunity all? So markets have come back. But if you see, a lot of stocks are either rallied significantly or actually gone down, right? So if you see on the left side, this is Nifty 50 stocks for last 20-month period, roughly. And you see ITC was one of the best performer stock. So I keep telling ITC is one such stock which was a meme stock to a momentum stock, right? Clearly, last 1 year been a darling. We have seen M&M also did very well. So broadly, domestic piece, right? L&T, Britannia, all the domestic piece did extremely well in last 20-month odd. And in the right expectation, the global stocks did not do well given what's happening in the Western world, right? From high inflation, high interest rate. Uh, in terms of couple of banks went down, even though they are very small. War is it still continued, and there is always this uncertainty keep coming, right? And if you see the weaker performer in the last 20 months, right, even though market is all-time high, a bellwether like a Wipro has lost 45% from the highs. So we can say the market is at the same level. There are different stocks are at different levels, right? And that's where I believe if we have money today, the opportunities always exist. Why? At index might not be the same level, but all the stocks are not at the same level, right? They're either up or down, and some ones are very high up, and some stocks are extremely down, right? So if you see within IT, very interestingly, Wipro is down 45%. The least fallen large IT stock is HCL Tech, which is -6%, right? Again, within IT itself, the difference is close to 39% among within IT stocks, right? So clearly, again, it boils to the same point. As long as your company can do better than the market peer, still it doesn't need to fall like what the markets are falling, right? So for every long-term investor, bottom-up approach do work, and this data clearly brings out market might be in the highest level, but there are different stocks at different level, right? And HUL is in the really at the midpoint next to Nifty 50. Nothing has happened in the last 18-20 months, right? So Nifty 50 has done 1%, HUL has also done 1%. So you have three polar, right? You have ITC, peak performance has come out in 20 months, Wipro on the down, and HUL in the middle. These are the names, but it gives you an idea about opportunity always exists. The question is where the opportunity lies is the matter, right? Because 20 months back, everyone saw ITC was cheap, but no one was willing to buy because it was a meme stock. But that's where sometimes when operating business turns around, you see a tremendous performance. Um, Moving on to the next, this slide reiterates the same last slide in terms of how the ranking has moved. ITC was 14th ranked company in terms of market cap. Today it's gone to 6th. And if you see Infosys, which was the 4th rank, it has gone to 7th. Clearly reflects the positions have changed, right? Who is now dominating the index? Infi used to dominate. Now it is actually ITC is also going to dominate the index, right? So clearly index is changing. So there is not the same index, even though the value is same. Index weights are very, very different than what 20 months back. So, okay, this is at the Nifty level. Now, let's see how does it look when I see the data on a BSE 500 level, right? So there are stocks, again, the market in this 6 months period is close to 2, 3, 4%, which on which date. So as on last before day, it was 7% from Jan 1st. But there are a lot of stocks have gone up 60, 70%, right? And then a lot of stocks have also gone up down by 30, 40%. And one stock has gone 80%, but obviously we know the name. The whole idea is not to call out a name. The broad message is, again, markets have come back to square one in 6 months, but there are many stocks have done tremendously well in the same period, and many have fallen down. So opportunity is not only at the top level has happened, even at the BSE 500 level, the story remains the same. There are stocks are a little more expensive today than what they were 6 months back, and some stocks are a little more cheaper than what they were 6 months back. So opportunity always there, who has a time frame. So this is a good start. I think calendar year 2023 started extremely well for all of us in terms of inflation is close to 3%. Like this is an annual, this is an half-yearly inflation, right? Because we have period 6 months. So if you have done an FD, you have done 3%. So we have matched inflation. Markets itself has delivered 5, which is 2% more than inflation. A typical balanced advantage balance funds have done 7, and the multi-caps has done 9. So it's a fantastic start. I think it's time to celebrate. But the point is, we make 9% in 6 months. It means we should not assume that we'll make 18% in 1 year, and then that's our right? I think these are historically slightly elevated return period. Typically, markets have delivered between 12, 13% on a very long period of time on a yearly basis, right? So you have inflation around 5, you market delivering 12, 7% over inflation is what markets have delivered, which I'll share the data. So having right expectation is very important. That's why I thought it's time to celebrate, but celebrate with caution. And I'll touch upon few risks which as a house we see, and it'll be good to have that perspective when we deploy capital. So how to think about risk? I think there's a fantastic data slide put out by Howard Marks also, right? In terms of risk is not about having a very certain outcome. It is a range of outcomes. And when we build portfolio or when we allocate capital in an equity, which is slightly a long-term asset, a probabilistic investing, the range of outcome can be not necessarily only has to be positive, right? I mean, if we start thinking that we'll only make positive money and it's our right, I think that's a precise time where the market breaks down. So we have to be a little more careful on how we think about it. And we always have to think in terms of probabilistic rather than a singular view. So the couple of risks which we see, I would like to call out 5 risks. The first risk is the there is a good expectation of strong earnings for next 2 years, which is FY 24-25. So I'll speak on the left side graph and then go to the right side. On the left side, broadly, what this graph suggests is the blue line denotes what is the 5-year EPS growth of any particular sector or the index, which is MSCI to start with. How much growth is projected for FY24 and how much growth is projected for FY25, which is in the light blue and yellow. One thing is very consistent. Almost every projection is above 10%, and which at some level it becomes very stretched. So let's take example of IT, right? If you see FY24 projection is between 12-13%. In a slowing world, with currencies not depreciating, right? Last 7-8 months, currency is close to that 81, 82. We might not have a growth of more than double digit, right? And if you look at a lot of listed companies have guided for a extremely lower end of a single digit, right? So it clearly reflects a lot of expectation is built in, and across the sector, the expectation is growth will continue to revive, which if we attain, it's fine, but that's already market assuming that is coming in, and that's why the market is pricing in the market. And if you look at on the right hand side, a very interesting data. This is basically where is the Nifty EPS and what's the valuation. And obviously, right, in the media, you keep seeing about markets are at average, so you don't have to worry. I agree, but with a pinch of salt, that average data is coming out of an assumption on the earnings, right? So last year, which is FY23 ended, we ended at 812 rupee EPS for Nifty. Before going to future, right, let's see the past. Exactly year and a half back, which is I'm saying March, right, 22 March, seeing to FY23, the estimates were 880 rupee. And actually, as the numbers came out, the market adjusted it to 812. It means we lost 6-7% of the projection from 880 to 812, right? We underperformed from our overall expectation to delivery. Even though we grew the earnings, we did not grow the way the market initially thought. Why it is very important? Now, if you see 812, market is today believe at an aggregate Nifty 50 will deliver 914 rupee earnings. This is a broad number, obviously, right? Few institutions will have a range. But it actually looks little reasonable, 812 to 914, not a very stretched, around about 11-12% sort of it. But the challenge lies are not 24, the challenge lies in 25, where from 914 you're thinking about 1,060, which is a very reasonably steep earnings growth on top of what the 23 recovery and 24 recovery. And any disappointment there will show up in the market, right? That's where we need to temper down our expectation and then invest, keeping the medium term, and volatility will come back when no one believes volatility will come back. So this is the first risk which we should keep in mind as an allocator of capital. The second thing which I thought it's very important to bring in from a flow, right? Because what surprised the market in the last 3 months, as I started off, it's time to celebrate with caution, is FIs came back big time. They have deployed roughly 60-70,000 crores of capital across large, mid and small, huge interest, rightly so, because if you take a medium-term picture, India is in a sweet spot, right? So everyone wants to deploy, but our valuations is not that cheap. And this is one interesting slide which published by CLSA a couple of days back, where on the left-hand side, if you see this picture, the dark blue line suggests the return on equity of India vis-a-vis emerging nation, which is close to today equal. I mean, if you see, right, we were higher, but then we have come close to the line. What it means is our profitability ratio and the emerging nation profitability ratios are very similar, right? Which is 14-15% ROE. But our valuations are close to 100% premium to their emerging nation. So if you have a very long-term investor, you can deploy. Otherwise, what happens? For the same profitability, you have to pay 2 times more to India, right? So this is where sometimes challenges can happen. Again, the similar data on the right side, bonds are still very attractively priced, above 7%. So there is an implicit assumption bond yields will fall, right? The policy RBI will cut rates, bond yields will fall, so the equity will become attractive. That's what market is today reflecting. But if inflation is very sticky and US can continue to hike rates, right? That's what the last Fed minutes spoke about. This assumption will be questioned and some volatility is possible. Third, within the market, the pockets where a little more look, what to say, iffy or huge momentum is small cap. Last couple of weeks, we saw a tremendous rally, right? This is from Kotak, which clearly called out in terms of mid cap also continued to trade at slightly more premium. So it there are pockets obviously cheaper, but at aggregate, it brings to a point, right? When there is so much optimism, we have to temper down our expectation, and that's a mute point which I would like to touch upon. Uh, the fourth point, this is nothing to do with market, but in the last couple of years, which is I think precisely last 4 5 years, there was a big narration of you need to buy high quality company, and high quality company typically trade a 50, 60, 70, 80 multiple, and you buy it and you stay for 20 years, you'll make money. But there are two difference in opinion. One, we all read Buffett, but typically we don't end up investing like Buffett for staying for 15, 20 years, right? I don't think we have that type of a money. Personally, also, no one has a 15-year, 20-year vision. We benchmark ourselves every day, what's happening with other portfolios. So, right. So, talking 15, 20 year is something illusionary in my view. I think some reasonable time frame of 3, 4 years is what I think people should set expectation and invest, right? Because in the long term, everyone is dead. So this is a small data on a 3-year period where a very high quality, a very, very high quality innerwear brand, I'm sure you know the name, or said you can buy at any multiple because this is a fantastic product, all agreed, right? Great business, no question about it. But then you end up paying at 60, 70, 80 multiple, where the entire market knows the story, right? There was no new buyer. And there are other story which I just touched upon, a cigarette company, meme stock, high free cash flow. Again, everyone knows the story, but it was very cheap. In some time, market just shifted, right? They just bought the cheap one eventually, and you know the way the money is made, right? 2 times more. So investing is not only about knowing what the good company, right? I think it's a good start, but the good end is, did you buy with good margin of safety, and did the story play out better than what you envisaged, right? I think these are small things which I thought is important, because if you still stuck with a portfolio which carries a very high quality business but still trading at 80, 90 multiple, you have to ask, okay, is that a good value investor doesn't know the stock? No, they definitely know. They really will like the business, but they don't like the price. That's why they're not buying in. So these questions should be asked. So I thought I'll share this data. And finally, as I touched upon in my previous comment on RBI, what's happening in global is also very important, friends, to see is there could be a potential rate hike scenario in Japan, right? So for good or bad reason, Japan has not gone through the rate cycle what US, UK, Europe, India, Australia, every other country in the world has gone through, right? Because they have kept the policy at minus 0.1. But very interesting development happening in Japan and off late is one, this wage inflation is going on a significant rise. And I think the top picture on the right clearly brings out, for a period starting 2000 to 2021, for a 20 odd year period, wage growth was close to 1 2% roundabout, right? That's where they've always paid. But finally, with inflation coming in, what we're seeing in Japan is wage guys are between 4 5%. And what it brings in, right? There is a tremendous pressure. Inflation is coming in, right? Because the companies are getting squeezed and they have to raise the prices to keep the profitability up, right? Now you cannot keep the policy rate in negative and allow everyone to earn 4 5% more, right? It's going to create an imbalance. So I think slowly Japan policymakers are thinking about how to go about handling the situation. For 20-year period, they never gone into it. So we're yet to see the end of rate hike cycle, at least from a Japan point. And I think post last week commentary on Fed minutes, it's clear that maybe there is little more hike before we come to an end, right? So these risks do come, and I think we cannot just ignore it because there is a momentum in the market. So to sum all this, right, we are a strong believer. This is a beautiful picture in terms of, in the short term, all it matters is sentiment. Actually, if I plot the 6 months performance of companies based on quality of business, quality of balance sheet, quality of cash flow, divide them into 6 universe, right? But if you see price action, it's all over the place. There are good companies have performed, there are bad companies have performed even better, correct? But if you stretch the time horizon by 4 5 6 7 10 year period, right? Clearly, the only thing will be mattered eventually will be the earnings or the cash flow or the intrinsic value, whichever the way we measure a stock or the business, right? So let's not get into that. Okay, right? The sentiment will always no. Sentiment is the biggest swing factor in value, at least in the short term, and no better evidence than last 6 months where we came from high to low by Jan to March and low to high in another 3 months, right? Within 6 months, sentiment has actually gone one full circle, and no better proof than this period to talk about how sentiment can fool us, right? From believing that will continue. No, that's where it is always important to wear to drive a car with a seat belt. I think that's the summon substance I would like to talk today. Definitely, there are risks which we need to keep in mind. It doesn't mean everything is gloomy, right? So I'll touch upon positive areas, but I think I want my people to take a little more of cognizant on the potential risk and then invest sensibly. That's what we wish for all our investors and capital allocators. So where the positivity, right? Having spoken all, the positivity is earnings, right? I said in the long term, it all matters is earnings, and this is the earnings for the top 25 Indian company. So we have seen the entire data, right? We run this corporate India presentation sometime back last month. I mean, a lot of corporates have delivered their all-time high numbers. If you see this picture, what we have done, we have just colored the highest profit attained by the company when. And if you see, close to 16 odd company have delivered their highest profit just ended FY23, right from Reliance, State Bank of India, HDFC, and so on and so forth, right? Clearly, the corporate India is doing extremely well. That's what our inherent belief is. This is buy in a dip market, buy in a staggered market, but you have to buy into it. Why? Corporate India is firing. Corporate India is doing good job. I think the way to benefit out of corporate India is to buy the listed equity markets. This is on the top for 25. The next is the BSE 500 pool of FY23 numbers. Clearly, close to 255 companies have delivered a very healthy double-digit operating profit growth and top-line growth, right? To put in construct, India GDP ending this year will be like the 23 was 270 lakh crores. We will be ending at 300 lakh crores by FY24, and we'll be doing between 10-11% based on whatever the expectation, right? So this 10% is a very good number to think about how many companies are doing above India GDP nominal growth, and you have a very large pool of companies are delivering, right? So the growth is very broad based. It's not coming from one sector or one segment. So this is where the opportunity also lies, but you have to buy a great asset, but at a right valuation. Like I shared the example, even though the Innerwear company is a high ROC, high growth, you are paid for all the multiple, so you don't make any money in the future. The third, very significant one on the flow. So first two is fundamental. The second is a flow. What in the medium term you can expect is FI should come back. If you see on the left side picture, FIs were 21% odd exposure in India and slightly drifted post-COVID recovery and all over social media, right? We are really innovating, and this wealth creation is going to create multifold. So what we believe in is, I think the last 6-7 years, India has created a fantastic digital structure, and we have put GST in place. There are a lot of things are firing from taxation, right? So we're in a good position from macro. Corporate India is firing. All we need to do is we have to be a little more disciplined and having right set of expectation. So having spoken about where are we in the market, how is the risk priced in and the opportunity. The two opportunity we as a house we are definitely very positive is wealth management, asset management, right? So these are business where like an IT company or an FMCG, right? High ROC, very high free cash flow, don't need capital. If you look at our per capita, right, with 270 lakh crores and 142 crore of people, we are like 2,400 per capita. And in next 2 years, we will cross close to 3,000 odd, or next 3 years, we'll cross to 3,000 odd per capita, right? Clearly, we are in that inflection point where a lot of financial investing will happen in next 8-10 years, right? So India has close to 100 crore bank account, and we have not even 1 crore mutual fund investor, right? So I think India definitely, for the size of the country, we will easily can have a 10-20 crores of a mutual fund investor, and which will happen over the next decade, right? So this is where some opportunities do exist at some point in time based on again valuation. And the second one is obviously, right, domestic pharma with 140 crore population. I don't think this one will be served a lot. And a very good example shared by one of the very lead analysts is, if you think about a spending 2,000, then you end up spending 8, 10,000 in a per month, right? That's how the spending happens when the aging happens. And India is exactly in the spot where in the next 20 years, one thing is very sure will happen is we will age, right? Because uh, we are not going to have a high birth rate, right? So because we are already a very populated economy, right? So we are going to age as a society, and that brings a huge back-ended growth. Obviously, this is not for the next 1 month, 2 months, but I'm saying someone is thinking about decadal, right? There is always this opportunity. And if you see, pharma has not participated big time in the last 20 months, right? So someone says, oh, there is no opportunity. I think we have to just ask the right question. I think the opportunity do arise in front of us. So putting everything into one nutshell, right? This is what ithought believes in, or how we think about it. We believe global is in a slow growth phase. I think it's going to be longer slow growth phase. Looks like inflation is sticky, policy tightening close to end cycle, but that's slightly getting debated. Geopolitical risk is very high. So basically, world is not doing in great shape. That's a reality, right? I think the more we realize the reality, the better we are. The domestic macros are decent. We are doing a moderate growth. The real GDP will be 6 to 6.5% based on whichever estimate. Inflation is moderating but still sticky. Policy also close to end cycle. But the best news on the corporate, right? Balance sheets are good. Corporates have gone through huge deleveraging in the last 5, 6 years, both banking and the actual corporate. So both the engines are ready, right? One engine to fund the economy is ready. Another engine to drive the business is also ready, right? So we are in a good state to drive next 5, 7, 10 years of a growth. They're delivering numbers, but valuations are mixed. Definitely, there are pockets of high valuation, and there are also pockets of affordable or a cheap valuation. So it's not one market, right? We cannot paint the brush and say everything is expensive or everything is cheap. That's not the way now. How we think about return, I think this is a fantastic data which we keep seeing every day, rather, in terms of what markets have delivered and how to think about setting the right expectation. So I'll take a minute to brief how to go about it. Different investor come into market at different point in time, and they will have a very different experience to start with. So let's take the example of 1994 investor. The first year was a okay year, right? 9% money, correct? On the year one. Year two, it is minus 8% CAGR. Basically, the market started going down. Till year five, it was extremely painful, right? You hardly not made money. But then you started making money, right? Year six, seven. And as you stretch it, right, on year 30, you have made 10% compounded, right? Very good. Now, if you look at a 1997 investor or a 1999 investor, right? You started at 66%, right? So what happens? You start having a very high expectation in life, and you think, oh, this is my birthright. I am going to make a lot of money. Year two CAGR is 19. Basically, the bubble burst in 2000. Year three CAGR is 6%. Actually, within 3 years, everything got corrected, right? So you started the first year, and you had a very high outcome, and then the markets collapsed, and eventually, right? Eventually, if you see the long term, the client 1999 investor have made 12, 13%, right? 13%. So finally, if you see a very long term picture, which is on the right side, the data is clearly pointing to only two things. It's around 10 to 13, right? Broadly, or 10 to 12 is a more broader. But I'm saying if you are very lucky to start in a very cheap market, you end up making little more money. So the expectation of 12, 13 is a very good expectation. I think 12, 13 is also not a very small return, because at 12%, you will compound your capital every 6 years. Where if you have to have a similar FD, right, it takes 12 years. So basically, you're going to crunch the time by 6 years, right? From a 12-year compounding capital to double in a typical risk-free, you're going to compound capital at 6 years. So which is, I would say, a very healthy return. Obviously, right? The second layer comes from you being disciplined, right? As an investor, if we are a little more disciplined about deploying money more when the sentiments are down, believing the long term, I think we can add another 1 or 2%. And finally, if we are able to find a great capital provide investor like what we are endeavoring, I thought in the four solutions, maybe another percentage or two, if we add up, I think that's where we do this 15, 16, right? The magic number where we crunch another 1 year instead of 6 year compounding 5 year. But I think this is where setting right expectation is more important. That's where I would like to end. Just to touch upon the data, our flagship scheme positioned exactly where we believe in this 13-15% return over the long term is sustainable, and that's come from how the markets have delivered in the long. We have delivered reasonably quite healthy 4-year return, but I believe this is all, I would say, a bonus phase, right? We have done exceedingly well. God has been kind, but we need to have the realistic expectation between this 12 to 15 over a long period, and anything above is to for us to have celebration. To finally sum it up, only 4 points. Setting realistic return expectation is very important. Definitely in this type of a market, we have to temper down our expectation and have a slightly longer frame. That's how I think all the experience will be good. We have to only bring durable capital into the markets, which is 3-4 year capital and not a short-term capital. Third, our portfolio should be positioned for multiple economic scenarios so that any short-term potential headwind can come, we'll be able to withstand. So one of the easiest thing which we all know is next year we're going to have general election. It can bring its own challenges, and we should be very, very clear. If you are a 3 years investor or 1 year, 2 year investor, you have to go through the cycle and you have to build a portfolio keeping that in mind, and not that next 3 months I should outperform the market. No, it's a very narrow objective. And finally, we have to be very disciplined, because at starting point, it is not a very, very cheap market. I think with that, happy investing. Thanks for your time, and we'll be very happy to take questions, anything. Not on stock specific, but we'll be happy to talk on anything on general except stock specific. Thank you. Tarun, over to you guys. You can put the question in the chat. I'll just see, is there any questions? Then is that right? They have to type the question in chat, right? Sir, you can, Shubham, can you type the question in the chat, which is on the top left? We'll wait for 2-3 minutes before the question comes. What all the sectors we can concentrate for next 2-3 years? I think there are definitely, so look at areas which has not run up, or so there are a lot of businesses where MNCs are getting more interested in India, and they are trying to bring new product or new lines. So just take the example of general insurance, right? Which is like a typically end up growing 5-6% more than India nominal GDP, right? India itself is growing at 11-12, which is a very healthy number. But if you see general insurance on the last 20 years have grown between 15-20% at the industry level, and then you have company specific level. So definitely there are a few sectors where the opportunity still exists, and that's where we are putting our energy and effort. So the question is, one, you find the good sector which is profitable, durable, then you find a good company, then you find good valuation, and then invest in, right? That's how we have to do it. So there are definitely, like I just told, right, a couple of new age companies are getting listed, which was never existent in the last decade. So I think this is a very important season for any long-term shareholders, because annual reports are just pouring in. As we speak, close to 200 companies have come with their annual report, and I think next 30-40 days is going to be a very busy season for all of us, right? That's where the few opportunities will exist. Hope I answered your question on what challenges you see in the next 6 months. I think I've called out the few challenges which I said. The biggest challenge will lie in the way we stay disciplined. Our expectation has to be realistic, which is markets in the long term have delivered only 12-13, right? So I keep thinking about the data is there with all of us. But there is an expectation. I would say people are talking about even not even 20% people are not happy. I think when we attain 20, I think the first thing is we have to go and celebrate and then keep ourselves saying, okay, right, it's been kind, but that's not the long-term return expectations. I think the challenge lies in how we behave to the market mood. The challenge is not external. External challenges will always exist. But the expectation of the markets have gone up. I think we need to temper down our challenges. Definitely, right. The one easiest thing is we might not have a favorable outcome on election, and we should plan for it, right? You cannot go blind. I think going blind in investing is not a great way. That is we believe in. How do you find the future growing sector? I think a lot of reading. I think few obviously right. We have to see where the relevance lies in. Definitely right. If India is now a 3 trillion economy, 3 to 5 trillion, where the relevance of what sector, right? It could be manufacturing, it could be general insurance, it could be wealth management, right? Because we never had something called unicorns and so on and so forth 15 years back. Today we are finding every next day either some other company getting funding, and obviously right, these are founders are becoming very rich on financial terms and they need wealth management, right? So obviously right, that's what the primary job of a research analyst or a fund manager is, to keep thinking on where the India is heading and where the opportunity lies, and then can we buy the asset in a favorable terms, because finally you have to buy in favorable terms to make money. Hope Gobi addressed your question on how to find a growing sector. But the good news is India itself is growing at 11-12%. So lot of sectors does grow between 8-9% to easily 13-14, right? All we need to find is a good idea also finally. Hi, sir, I'm 20-year-old. Should I pause my index fund SIP as of now due to premium? No, not necessarily. I think, Kishore, first of all, congrats. At 20 years, you have become a disciplined saver. You will go a long way. Market will become overvalued at times and get cheaper also. The whole idea is I did not say it's overvalued at fully, right? So only thing is be disciplined. Since you are doing SIP, right, I think you should continue to do it, because that's what the discipline. I think you are a precise outcome of what I was saying in terms of you have to be disciplined of saving every time, and you should not put a lot of money now, thinking market tomorrow will go up and I'll make. No, you are actually getting it. So you are in a perfect mode. I think you should continue and strengthen your case of investing more systematically, right? So you are doing, let's say 5,000. I'm just giving a random number. You should go next year with 6,000 every year, right? Every month. I think be disciplined. Market will definitely will reward you in the long term, Kishore. Thanks, Balaji, for the comment on good presentation. Is it right time to start the portfolio management now? The every time is right time. So one of the way I would like to address is in I thought we don't do deployment in day zero, sir, Ayyappan sir, in terms of, so as long as the money has come in, we obviously knowing this, we appropriately position our buying behavior. So if you see our Solitaire fund, the day one deployment is only 40% today. It means we are not doing cut, copy, paste and buy the entire portfolio, because as I rightly said, few stocks are very cheap, right? So you have to go and buy the few stocks, but the stocks which we like, which we want to buy to you, which is expensive today, we will see, we will get better entry. And we saw that, right? Market gives you a chance in no time. And I think the most prepared mind can capture that, right? That's how we play. I think every time is a good time, but you should have right expectation. That's very important. In the long term, our endeavor is to do between 12 to 15 in Solitaire, even though we have done 22% CAGR. Having right expectation and a right time frame of 3-4 year capital, I think we are well served. Hope that answers your question, sir. What about ETF investment instead of MF and stock? Is it good move? Can I start ETF? I think everything has a merit. Definitely, stock is not for a lot of people because it's a very active role in terms of if you have to do a stock investing, because there are many variables, right? Which if you are putting your own money. So I'll just give an example of why I would say it needs a lot of effort. TCS, which is the largest company in IT, gives close to 350 exchange release in a year, right? Typically, in a single day, it gives you one press release. If a company like an TCS, where we know intuitively what they do, a lot of our friends might be working in this industry, right? Still, so much data comes out of them. This is apart from that, they come in media, they come in analyst con call, they give you annual report, they give you business stability report. So much things will come in, right? So if you are a stock specific, you need to deploy at least 3-4 hours in a day to be a good at. Then you should do it. Otherwise, I think MF is a fantastic platform. Undoubtedly, for a lot of common investor, the greatest platform built globally is a mutual funds. And I think the better version, little more, is also ETF, right? Those who want to say, okay, I'll take a call on which index to invest in. So there is no I don't differentiate between ETF and MF. I still prefer a lot of mutual funds. So I think I leave that to you. But for a stock specific, you need to invest a lot of time. Otherwise, you better be with. So instead of making for maximization, look for optimization, right? Which itself is a good deal, I would believe. Do you expect valuation of IT sector become more attractive in the near term? No idea about what happens in near term. What we can tell is it's a very, very profitable industry, an industry where governance standards are very good. They are free cash flow generating business. So this is on the positive side. Obviously, right, in the last 10 months, they have not done well because they were having elevated expectation. Again, right, what is built into the expectation is important. I think we're still out of the cycle, and the big risk also have to be thought on how this generative AI can play in terms of um, um, do they get more competitive because you might get some co-pilot sort of an assistant, right, which can create lesser demand for their existing resource. So we have to think about it before taking a call. But otherwise, generally, it's a profitable industry. But we are slightly underweight at a broad level in IT. Pharma will recover soon, domestic or export, which will outperform. I think if I know, then all the money I'll put it there. But I think as a house, we believe pharma is a definitely a good sector. It's not a very bad sector to call off. Obviously, right, last 8-10 years, it's fallen off. In our portfolio, we have three pharma names, have a very distinct character. So you have to be very specific in pharma. Particularly, there is no two company are very similar because the way they serve, the category they serve, the market they serve. So one of the company doesn't do an M&A, right? And if you see historically, the big money is lost in pharma company where the company go and acquire an asset and finally after 6-7 years they do a write-off. So we figured out one company will never do an M&A, right? So you have to be very choosy on the names. It's a very, very, I would say, within a pharma, there is a lot of pharma companies, right? So there is no one type of a company. Every single company are very, very unique in that way in pharma. Very slightly complicated industry in that way also, because regulation also do come in. Question from YouTube Live, Shaktivel, how do foresee AI impact on Indian? We have to see, sir. This is in early days, Shakti. Definitely, all are waiting for next week commentary. But I was just going through Moody's Investor Day happened yesterday in US, and one of the things they were talking about is AI will super speed a lot of work. What does it mean? Instead of I doing a work for 1 hour, I can do it in 10 minutes. It means either I become 6 times more productive, or we don't need 6 people, you need 1 or 2 people, right? So these are very early days. I think we have to see as it comes, but we have to be mindful. We cannot go blind. That's what I would say, right? People are just talking about it, so let's keep thinking about it. And when you see Nvidia, right, which is clearly reflecting the rise of AI, right? So it's real. AI is real now. Now we have to see who is the loser and then try to have their exposure minimalistically. But it will take some more time to understand where the true impact lies in. Hope I answered your question, Shakti. How do you see mutual fund and bigger HNI buying storied new stocks like Zomato? It's still not profitable. I think profitability is not the only measure of intrinsic value. Profitability is definitely an outcome in the long term, right? So if you look at Bharti Airtel also in the initial phase, they never paid dividend. And one of the theories, if the company is not paying dividend, it cannot create value. The biggest value got created in Bharti Airtel was the period where they did not pay dividend because they were very profitable and they were growing India telecom business and they made it. So I think let's not look at only definition of profit is the final thing, but definitely profit is needed so that you don't need external capital and so on and so forth, 100%. But few businesses are creating impact. So let's take Paytm, right? We don't have any exposure to these three names which has been called out. But think about Paytm, right? I'm not getting into the final numbers. Did has it impacted the society? Of course, right? You are able to see it, right? We are seeing everywhere. So definitely this is not a zombie company. Doesn't exist. No, Zomato is there all over the India, right? I'm sure all of us are either a customer of Zomato or a Swiggy, right? So these are not zombie companies. Definitely they have to rework on their unit economics. They have to rework on the way they communicate to the market. But it's a company which is worth paying some attention. At a time in a public market, should you invest? Maybe, right? That's something a debate for some time. But I think these are not fly-by-night companies, right? These are real companies, and some of the companies eventually can become a biggest wealth creator. We don't know, but everything has to evolve, right? That's why in the beginning we never participated in any IPO. But definitely it doesn't mean we don't learn, right? These are really, really impacting the society. And I just shared the picture, right, of Nandan Nilekani PPT, where now we are doing all the funding using Paytm, right? It happens everywhere. Even a 5 rupee, 10 rupee payment we are doing using our UPI code and so on and so forth, right? So few companies will definitely benefit out of it. Nifty is all-time high. Is it good time for long-term investors? Nifty will always has to all-time high, right? Like our age is all-time high as we speak, right? So Nifty is only 50 stocks. So let's instead of asking this good time to invest, manner, so that even though we are in a slightly higher market, but this higher market has come after 20 months. So it is not like a very high, but we should have right expectation. So if someone is saying, I want 25%, that's what expectation will actually we will fail in the beginning itself. At 12-15, I think India should do. We are in a good wicket. Hope I answered to Harsha Raj. Thank you. Thanks. What's your view on speciality? We don't own any of the names. As we keep thinking and hearing, world is going slow down, right? So usage of chemicals will go down. It's a natural outcome because of the end industry going to go to slow down, and there is excess capacities coming in, right? And people paid multiple, so now they have to pay, right? So we have to be careful, but we'll keep studying, right? There could be one idea which can come up, but otherwise, broadly, we don't have any big view on specialty chemical, and neither we have any exposure in our funds. What about infra and oil and center? I think infra is doing firing in all cylinder. If you see this government clearly have taken a policy of capex-led, infra-led growth than a consumption-led growth, right? And you're seeing every company on capital goods, EPC, firing in the business. So again, but you cannot buy any stock at 80, 90 multiple or 60 multiple, right? That's not the way. Oil and gas sector, I think resource will become very, very important. We are in a fractured economy in terms of there is always this rift between which country will give which mineral, right? Recently, we saw our neighbor country said, I'm not going to supply some minerals which need for semiconductor. So definitely there are going to be a lot of tussle. We are no more pre-COVID, right? I think it's a place where there are going to be more frictions coming in. That's where I say the risk has actually gone up in the society, and we should understand the risk and then invest rather than saying risk has gone down. No, there is so much risk than what it was 4 years back. So minerals and oil and all can do really well, but from our public investing, it becomes very, very challenge for in a portfolio because the swing factors are multiple. So it is not advisable for a lot of investors to own this company where the stocks can fall 20-30% on no time. So these are not a very stable sector, but definitely it's a very important sector. Thanks. Thanks very much. Insightful. Thanks. I read an article that most PMs underperform mutual fund because of expense. So is it person only 55 lakh now is a wise decision to put entire amount or good investor in mutual fund and grow capital one grow? Sir, I think it's debatable. I think we have clients who have 50 lakhs and come to PMS, or we had 30-40 lakhs and they had some 5-10 lakhs of FD also moved to PMS, and there are people with 1 crore also come to PMS. All I can say is I've shared the data on us. Will be happy to talk on the way we have done. What I did not share also I would like to talk is we have done pretty well. Instead of thinking about underperformance, overperformance, why are we coming into equity market is a very important question. So we have inflation, which is 5-6%. We are coming into equity to create real wealth, right? So as long as we all do 15-20% over a long period of time, I think it's a very great place to be in. That's my starting point, right? We have made more money than what because of inflation, you would have lost some wealth, right? The real wealth got generated by delivering 15%, right? I think that itself is so good. I think there is so much of people like commentators talking a lot, and the practitioners are not able to talk. It's easy to comment about underperformance, overperformance. No one can predict who is going to be the next best fund in the next 1 year, 2 year, right? It's like it's an endless activity. Rather, all I have to worry is, okay, right? There is an inflation of 5-6%. As long as I make 12-15%, right, which is like 2 times, 3 times more than inflation, I should be fine. I mean, this is the mood point, right? So one of the opposite question, I think I'll give you a thought and you can think about it, sir. Let's say the markets have delivered 15% and inflation is 20% like other countries. You actually lost wealth because the same service would have costed you 20% and markets have delivered 15. Let's say index has delivered 12 and the fund has delivered 15. The fund has done outperformance, but actually you have gone poor, right? Because your real wealth has gone down. So I think when we make 15% with the 5% inflation as a society, we are, first of all, celebrate, happy. And if you're lucky, we might have the winners. That's all I think I would submit, even though if you see our data, we have done 400 basis more than the market, right? So maybe we are lucky enough to be on the right side of the outcome. We are very kind enough. And this has been achieved with a 30% lower risk. That's what our endeavor as an I thought, where you don't only deliver good performance, but you take lower risk. But I think more we attain around 15, 16, right? I think all of us are winners. I think we should be happy. We'll be very happy to engage you post this call, sir, if you would like any other inputs. Hope I answered your question, Srinivas and Murugan. Do we need to continuously invest in profit back into the portfolio management? Can we withdraw the profit regular interval, keeping the principal fixed? I think every money is your money, Ayapan sir, in terms of right. So you can always give money, you can always hold the same capital, or you can deploy, but your capital cannot go below 50 because regulatorily capital is 50 lakhs is needed so that the fund is viable. I mean, in terms of from a regulation point, as long as it's above 50 lakhs, it's fine. But the whole point is what you do by taking the money off is a question, right? If the money is well served in your portfolio, the money should stay there. I mean, that is a very individual call. But one of the things which we practice very meticulously is we do call for capital if there is a good idea. And any saver, typically we end up saving every month at some value, right? So as long as we find value and you have a 3-4 year time frame of a capital, you should deploy it. You don't deploy is also fine. Your view on long-term prospect of energy sector in India, I think without energy, there is no society, right? You remove energy, nothing is there in life. It's like an energy for the body. But the question is, what type of a sector you get in, who allows you to make money, what valuation you buy in, what holding period you have, what IRR you're thinking, all that determines, because it's a very, very important sector. Profit seeking cannot be the only objective, right? That's why a lot of PSUs are there in energy sector. We have to be mindful, but definitely right. It's a very important sector to be in, and it has a good weight in the markets also. So small case in your opinion, like small retail, I think you're better off going to mutual fund. I'm not a big fan because one, everybody gets the same stock, and I don't know how good their team is, right? If you think about a typical small retail investor, mutual fund can be fantastic because there are 10, 15 large analysts and a lot of institutional repositories there for 100 years. And they are trying, and there is a public track record of how they have done for 10, 20, 30-year period, right? When you have data like that, why would you like to do? I don't find a big reason. But then the choice lie with you, sir. I leave that to you, Rudra. Could you publish post-tax return as well, considering the dividend? Whatever we have shared is a post-tax return, sir, in terms of what we have shared. Assuming most of your solid investor could be in 30% tax bracket. I think capital gains will happen anywhere, right? If you make money both in direct equity or PMS, you make capital gains. One of the way we also run our portfolio is our churn rate are pretty low. If you look at the 4-year track record, roughly our churn is close to 0.2 to 0.25, which is on a 4-year basis, we only fully rotate the portfolio. But in the last 1 year, our churn has gone to 0.1 for the first client. It means we are actually holding for a long period. So your tax incidence also come down. But otherwise, all the return what I've shared is the post in terms of expense. Tax is something which you will do it, right? I think that's where it lies. Solitaire returns haven't been par with. I think we have done exceedingly well on good flexi cap. If you think about it, on a 2-year period, markets have delivered 11, 12. We have delivered 20, 21. Funds have done 9, 10. I think we are like 10, 15% more than flexi. But our objective is not to say that we are the best or we will be the best. You come with a 12, 15% return expectation in the long term with a low risk. That's a solid promise. And let's take as it comes, right? Because last 4 years, that's what we talk to our clients, our shareholders. We are very happy who gave us an opportunity to serve. And today, when we have delivered 22, we say our promise continue to be, we take decision keeping this 12 to 15 with low risk, right? That's where a couple of ideas which we bought worked really wonder because we don't want to take excess risk. That's not for public investing, we believe. You take lowest risk, deliver sustainable money. There are people to serve well, and I think our shareholders should be very happy of what we have achieved so far, and we are very committed to do what we have been achieving over a period of time. But then there is a lot of luck in this game, so there is nothing where we can say we will be the highest, right? That's not our objective. Do you expect PSU banks grow as much as best private sector bank in the long term? There are two different parts. When stocks are very cheap, the price can reflect. That's what happened with SBI, Bank of Baroda, Canara Bank, pretty decent. But there are a host of PSUs where the business fundamentals are very poor, right? So instead of generalizing PSU, There are few PSUs who are doing extremely good job, like a private or sometimes better than the private. But I would say I generally lean towards a private because whose goalpost you are running is very important. I think a good rally of PSU has already been done. You have to be choosy. Otherwise, you just go to any ATMs of a PSU, you will understand how well it is run, and that gives you an idea about how well they think about their customers, right? So that's the easiest way to assess how well if organizations are run. And within the PSU, if you see few PSUs of ATMs will be fantastic, right? They will be working, they will have clean condition, or and few will be really, really junk. I think that's the easiest way to assess is it worth even thinking about investing, right? And I would like to end there. How much of Solitaire clients have already made the return mentioned in the slide? Do you track and report? I think at client level we don't report, but obviously, right, this entire 560 crores of assets which may manage in Solitaire, the return belongs to that, right? This is the entire fund return. Obviously, clients have made few clients have made little more than what the fund return. At fund, we are close to 400 basis over the benchmark on the long period. The clients also, few clients have made more, and few will be little less. But I think we are well served, and I'm sure once you join, you will be also able to see it, sir. I think. Thank you. Thanks. I hope I answered all the question. We'll wait for a minute or two, otherwise we're good. Thanks all. If there is no further question, thanks for your time. Hope we have added some value to your precious time. And to end, this is a great market. Stay invested, but with the right set of expectations so that the long journey is taken care very well. Happy investing, happy weekend. Kudos. We'll see you back. Thank you. Thanks, Tarun.
Thank you, sir. Thank you very much. And thank you all for attending the session. You can contact us through the email ID or phone number, which will I post. Thanks. Thank you all.